Hello, good people, and welcome back to G-World Markets Academy. During our previous module, we discussed about leverage, and I believe by now you've gone through the module and you clearly understand what is leverage and how it works. Today, being our last module on this topic, we are going to discuss about margin requirement, and margin level. These are other very important terminologies which you will interact with during your daily trading sessions. So to begin with, what is margin? So margin is the amount of capital required for you to be able to open a certain or specific position. So this is not a fee nor a transaction cost. Basically, is capital withheld or you need to have for you to be able to maintain a specific position. The fee or the transaction cost is a different case altogether. This capital, which you are calling margin, is expressed as a percentage of the maximum lot size with reference to leverage. Remember, during our last module, we discussed about leverage and how it's expressed as a ratio. So this ratio, it's used to determine the margin requirement for whichever position you would want to take. So let's take an example of a case whereby you have a leverage of 50-1. In this case, you choose to have, every time you invest a certain amount of capital, you have a maximum of 50 times leverage or loan from the broker. So the margin requirement for this kind of a leverage, it will be equivalent to 1 divided by 50 times 100 expressed as a percentage. If we were not to express it as a percentage, it will be just 1 out of 50. If you had 100-1, the margin requirement expressed as a percentage would be 1 divided by 100 times 100, which gives us 1%, the amount of capital you require for you to open a certain position. So assume you'd want to open a position of 1 lot and you're having a dollar account. Using the example here, you will be required to have a margin of the lot size you'd want to take, which in this case is 1 lot size, times the margin requirement as a percentage. Or just say the lot size multiplied by 1 divided by 50, which gives us the same value, $2,000. So for you to open a lot size of 100,000 units with a leverage of 50:1, you require a capital in your account of $2,000. That is the margin requirement. It is not a loan, it is not a fee, but it's money you need to have in your account to be able to open a certain position. If this changes to 2 lots, again, this value will change depending on the size you pick. And that is the margin requirement. Whenever you open an account or a platform, you'll be able to see that figure appearing on your screen every time you take a position. So having looked at required margin, we need to look at now the margin level. And the margin level, expressed as a percentage, you also use the equity and the used margin. So in this case, we are saying you have money invested in your account and you have already taken some positions having utilized some capital as the margin. So when you take that value of equity, you divide by the amount of money you have utilized or the capital you have utilized to take the positions, it will give you the margin level as a percentage. And how do you arrive at it? Let's take an example here. You have an equity of $10,000 and you choose a leverage of 50:1. Just continuing with the example we have had before. Then assume you want to take a lot size of 100,000 units, which is 1 lot. Remember, based on the leverage utilization, you have chose 10 times of the available leverage for you because your account has 10,000 units, but you choose to work with 100,000 as one lot, which means you've taken 10 times the capital you have. So the required margin, as we have seen earlier, it will be 1 divided by 50, which is the leverage, multiplied by the lot size you have chose to take, 100,000 units, giving us 2,000. So this becomes the used margin after you have taken that position. So the margin level then, it will be the capital you have divided by the used margin, or the margin which has already been taken, or the capital, multiplied by 100%, which gives us 500%. So 500% is the margin level. It is a figure which keeps changing, because whenever you take a position, it might either have a gain or a loss, and the equity, the margin level keeps changing as your account value changes. So what does this value tell us? So the margin level, it helps to know the amount of funds available for you to take new positions. So the higher the value, it means you have more free margin available for you to take more trades. So anytime you see you have, say, a certain percentage, it doesn't matter how much, but so long as you've managed your leverage properly, your risk is well managed, your margin level will always give an indication whether your account is performing well or not. But the details of how that is calculated, you only need to know what figures are picked and what values are picked, but the system will calculate that automatically for you. All you need is for you to be able to manage your leverage properly and your risk properly. So that brings us to the end of our discussion today, and also the end of our ongoing program about the basic Forex terminologies. During our next module, now we're going to start digging deeper into other factors of Forex trading, and we are going to start with chart types. These ones now will help us to interact with the platform, get to know what charts to use and what different charts mean. Kindly leave us a comment, subscribe, and hit the notification button so that you'll be notified once we release the next video. Thank you, and bye-bye for now.